What's going on, guys? Welcome back to another video. So in this one, I have a lot of really interesting things to cover with you guys. This is an action-packed week, coming off a pretty slow week last week. So last week, short trading day Friday, a lot of choppy nonsense happening. But this week, we are starting to see the volatility pick back up for a couple of very specific reasons, which we are going to cover. Now, again, we do have to talk about this margin debt situation here that we have been covering over the last couple of months when this data does come out, and an over $200 trillion derivatives problem that we also need to be well aware of, especially with the amount of volatility that we are seeing in our markets. Now, again, guys, before we get into all of that information, if you wouldn't mind hitting that like button down below, helps out a whole lot with the algorithms, and make sure you guys hit that subscribe button and turn on that notification bell so you never miss another video like this. Now, let's get right into the chart over here, and we're going to take a look at the SPY very quickly. So, looking at this chart here, there's a couple of interesting things that we've been talking about. Now, we are going to talk about this 4-hour time frame again, but this is how the SPY is looking at on the daily. You ran right up to this 200 EMA, rejected. You ran right up to the 200 EMA again, got a nice close above, and then rejected right back down to the 13 EMA on this daily time frame. Now, for the first time in a little while here, we have seen the RSI cross down below its moving average. So, what it appears to be right now is SPY is losing, and the overall market is losing that upward trajectory that we have been seeing. And combining this with the daily time frame here, remember how we were talking about this rejection back down to about 390.63? We are seeing something very similar happen right now on this 4-hour time frame. And again, the MACD is building that bearish momentum. We're seeing the RSI come down below its moving average and that midpoint there, and things are looking like they want to kind of move to the downside. Now, again, when we're looking at all of this volatility, as always, I do want to highlight some of our members here. We got a couple of 11% gains on the day, 2% gains on the day here. Elgene with a 38% gain on the day over here, 3%, but the winner, Tabasco Dave, 61% gain on the day with 1348 in our proprietary algorithms, Invictus, Pythagoras, and Trader Joe. You're in a really good spot to make money in this market. And again, guys, this is also the last week to secure that $49 offer that we are giving you guys for when our platform releases very, very soon. So all you have to do is be a part of our community before that goes live. And this is the last week that you guys can secure that. If you guys are interested in all of the cool things that we have coming, make sure you guys check out that link down below. But moving on here and taking a look at the dollar on the daily time frame, this is the second time that we have seen the dollar come down and test this 200 EMA. Now, the first time, which we were calling here, came down, tapped, and then rallied back up to that 13 EMA on this daily time frame, sold back off, and bounced, almost creating a little double bottom here. If we can get the dollar above this 13 EMA on this daily time frame, we could see some more market moves to the downside. Now, looking at the 10-year as well, again, we are seeing the 10-year yield starting to kind of move back down, and that's going to be something that we watch for development as well. Now, the last thing that I want to touch on overall market developments before we get into some of the reasons why we saw the market come down today and what we have to look for going forward with this derivatives exposure and margin debt. Tomorrow, we don't necessarily see any crazy amounts of economic data. We get some home sales and real estate, or home price index and real estate data coming out, consumer confidence. Wednesday, it starts to pick up with the ADP employment report. Remember how much we've been focusing on the labor market in terms of getting an idea of how the Fed is going to react and where they want to take rates over the next couple of months and quarters. That is going to be a really important report, along with real GDP revisions, Chicago PMI, job openings, job quits, pending home sales index. But Thursday, it heats up even more with jobless claims, PCE, price index data, disposable income, manufacturing data, and again, Friday, non-farm payrolls, unemployment rate, average hourly earnings, more key data there as well. Now, thinking about where everything is right now in terms of where we are on the charts, we are in for some volatility this week. Now, it's going to be a really big data-driven week, but looking at these charts here and what we've said earlier in this video, it does look like the market does have some room to fall. You're going to be watching that 390 level for a pretty clean break, and this 390 to 402, 403 range that we're in has been pretty choppy. If we're able to break out of either side of this range, there's going to be a lot of money to be made here. Now, again, one of the reasons why the market was selling off today as well is Bullard was giving an interview to MarketWatch. There's still a heavy degree of expectations that inflation will go away naturally, Bullard said, but he also said that the Fed has a ways to go on restrictive rates, adding that markets are underestimating the risk that the FOMC will be more aggressive and have to go higher on rates in 2023. This goes along with a lot of what we've been saying recently, that a lot of big money is basically begging Powell to pivot. That's not going to happen. We still have inflation. I believe the last inflation report, the CPI, came out at 7.7. The Fed's inflation target is 2. We're at 7.7. Now, yes, that is showing that we're moving in the right direction, but we're nowhere near where we need to be. Now, again, we do have some opportunities to make money on the Fed overcooking everything with that TLT trade that I did make that video for you guys on. But again, you have to think about what is happening in general with the market and all of the data coming out. Are things starting to turn in the right direction? Yes, they are. But it's not enough for the Fed to really back off of these rate increases, which is why we also saw today that the Fed officials were really uncertain as to how high these rates were actually going to go. And how high would essentially mean the terminal rate, or the highest that the Fed is going to take rates before they stop raising and actually bring rates back down. Now, I also want to bring up this quarterly derivatives report that we've talked about recently in the past, but when you look at these reports here and you're looking at the total derivatives exposure of the top 25 holding companies in derivatives in millions of dollars, there's a $264 trillion notional exposure. Now, it's in millions, so you have to do a million times a million, which is a trillion. When you see 264 million right here, that's the math that we are looking at. That is a crazy high amount. And with the volatility that we've been seeing, these large financial institutions holding these leveraged positions can cause a lot of risk to the underlying financial institutions that we see. Now, is this really going to be that big of a problem? Well, we'll have to wait and see on how these exposures are actually going to change over the next couple of months here. But the one thing that we can kind of tie into this is the margin debt data that we've been looking at over here. So looking at the FINRA margin debt and the SP 500 real values adjusted to present day dollars for September, it was reported in October. We should be getting a new report very soon, which is why we're talking about this here now. We have seen overall margin debt absolutely tank. Now, this chart is inverted on this y-axis over here to the left to give you guys a better understanding. If you look at it lined up like this, it's a little bit confusing, but as you see this red line go up, meaning margin debt, it's actually coming down, as you can see, 1,000, 800, 600, 400, 200. So what we've seen as markets have become increasingly volatile, and we've seen markets sell off very significantly this year, is people are going more risk off. Now, this also brings us back to that concept of TINA. There is no alternative in BAA, B-A-A-A, bonds are an alternative. So if you start to see a lot of these large money institutional investors going risk off in a rising interest rate environment, well, they're going to take on less leverage positions and be a little bit more careful in terms of capital allocation. Now, they're still yield hungry, but where can they get those yields? The bond market. So we're still watching these developments here, but with the overall derivatives exposure, the margin debt coming down, and we could end up seeing some turning points in this margin debt here as we head into next year, depending on the overall sentiment. But what you can look at here is as margin debt goes up and people are increasing the amount of debt that they're taking to hold equities, well, you can see markets are going to come up along with this. It's a pretty linear relationship when these are pretty one-to-one relationship when margin debt's going up and when the market's going up too. So if we start to see margin debt peaking back to the upside, well, that would tell us that investors are more willing to go risk on. We could see more risky asset classes start to come up and more capital allocated into the equity market as investors are starting to take more risk. Is that now? No, absolutely not. We are still in a rising interest rate environment. We need to see how these companies are going to perform in Q4, especially these retail companies, that are going to really give us an understanding of how consumers are spending their money. Is inflation becoming entrenched, which means essentially, are people just spending money willy-nilly right now under the pretenses that they think that these prices of goods are not going to come down in the future, so why wait to spend more when you could just buy those things now? Or are people holding off thinking that the prices of a lot of these goods are going to come down? But to kind of wrap all of this up in a nice little bow here, we are in for some pretty aggressive volatility this week with all of the data coming out. And again, what you guys may not know, it's either on the 13th and the 14th or the 14th and the 15th. It's 2 days in a row where we get CPI and the Fed meeting. So December is going to be a very, very crazy month. And again, with the tools such as Invictus, Pythagoras, and all of the new crazy things that we have coming for you guys in our community, we are set up very well to really fully capitalize on all of this volatility and these volatile moves coming into the end of the year. So guys, that is going to wrap up this video. If you did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening. I'll see you guys in the next one. Peace.